What's up everybody, Steve here. Look, if you're gonna buy a home with less than 20% down, it's imperative that you guys understand what PMI is. PMI stands for private mortgage insurance, and majority of lenders are gonna require you to pay for private mortgage insurance if you are in fact putting less than 20% down on your mortgage. A lot of people hear mortgage insurance and they think that it actually protects them. In fact, it does not protect you at all. In reality, it protects the lender in case the borrower defaults on their mortgage. And the reason why I'm bringing this up is a lot of people see it in their closing documents, they see it on their loan package, they don't really understand what it is, and it can be quite expensive, so I kind of want to go into some financial numbers with you guys. So essentially, the private mortgage insurer is going to insure the difference of what is owed if a lender has to proceed with a foreclosure or a short sale. Now again, majority of loans are going to require PMI and you pay monthly for it. So it doesn't matter if it's a VA loan, FHA loan, conventional loan, even a jumbo loan, anything that's going to be less than 20% down is going to require this. So let's take for example an FHA loan. Now FHA loans traditionally have a 0.55 to roughly about a 2.25% annual premium. So in a quick example, let's say there is an annual premium of 1.25% on just a $200,000 loan. Now you simply take $200,000 and multiply it by 1.25%, and that's going to be an annual premium of $2,500. If we divide that by 12 over a 12-month period, that's going to be $208 per month additionally that you're going to have to pay. So let's say you got that $200,000 loans at a 3.5% interest rate. Over a 30-year period, your monthly principal and interest payments are going to be $898. But don't forget about that $208 that's going to be added on top of your $898 monthly payment. That's a 23% increase of your overall loan. So let's talk about some ways that we can avoid PMI. The first and the most obvious is you don't get a loan, you pay cash for the property. The second and most obvious is you put down at least 20% or more to get that loan. The third option, and it'll work in many cases if you guys are improving the property or the market is in fact increasing in appreciation, you notify the lender once you believe your loan to value drops below 80%. Now there's certain stipulations in terms of how long you have to have PMI before you could apply to remove PMI from your loan. So you're going to want to check into the individual loan docs or ask your loan broker or your banker in terms of that duration of how long mandatory you must have that. And also in many cases, for the bank to proceed with dropping off that loan, you're going to have to pay for an appraisal at that time. And another option to remove the PMI is to refinance into a new loan where you do have that 20% equity position. Anyway guys, I wanted to make sure that you guys do understand the significance of PMI if you do have less than 20% down. And in some instances, if you guys are close to that 20% down, it may make sense to hold off a little bit until you get the appropriate down payment so you could avoid this high payment where you could utilize this money and invest it elsewhere. So I appreciate it, and check out some of these other videos I got coming up next. Thanks a lot.